Hello guys, welcome to the new video of Yes Abhishek, Autonomous Computational Ecosystem Nexus. My name is Abhishek. Today I am talking about the financial convergence, how NBFCs will bridge the CBDCs and crypto. The financial convergence. The global financial system is currently fighting a silent civil war. On one side, you have old world, central bank, fiat currency. It is safe, it is regulated, but it is slow. On the other side, the new world, crypto, DeFi, it is instant, it is programmable, but it is volatile, fragmented, and risky. Governments are experimenting with an answer. Central bank digital currencies, CBDCs, Digital Rupee, an attempt to digitize cash itself. But there is a structural limitation in their current design. Most CBDC pilots operate as controlled or closed loop systems. They don't directly interact with public blockchain. They don't natively speak to Ethereum or smart contracts, but if you hold digital asset and want to buy something in real world, a car, a house, a factory, you still face this. 3 to 5 business days, manual paperwork, high settlement and conversion cost. The old world cannot process the speed of the new world. But what if there is a third player, regulated enough to trust, yet agile enough to understand the code? This is not the story about banks or Bitcoin, this is the story about the NBFCs. Welcome to the financial convergence. The problem with the banks. To understand the solution, we have to respect the constraint. Why can't traditional banks simply lend against the crypto or stream programmable payments in real time? It is not just a policy, it's architecture. Most global banks still operate on a core banking system designed decades ago. Systems optimized for stability, not interoperability. A bank ledger is static. It says person A has 100 units. A blockchain ledger is programmable. It says if person A does X, then transfer value to person B. Asking a legacy bank to interact with a smart contract is like trying to run modern AI software on a typewriter. This creates a massive liquidity gap. Trillions of dollars of value exist in a digital asset, but much of it remains economically underutilized. You can trade it, but can you use it as a formal collateral? Can you finance productive assets with it? For most banks, these assets remain invisible. The architecture of the bridge. This is where NBFC operate differently. They do not hold retail deposits. Their core function is lending, financing, and structural credit. Because of this, NBFCs are structurally more agile. Think of an NBFC not as a traditional bank but as a interface layer, an interface between CBDCs and crypto. Let's look at the illustrative example. Ravi is a software developer in Pune. He earns income in stable coins. He holds digital asset in self-custodial wallet. Ravi wants to buy a car. He doesn't want to liquidate assets or trigger unnecessary tax events. A traditional bank sees limited recognizable income. A, a potential future workflow could look like this. 1. Ravi opens a regulated NBFC platform. 2. He voluntarily connects his digital wallet. 3. Asset ownership is verified using compliant on-chain verification mechanism. 4. Digital assets are locked as a collateral through auditable smart contracts. 5. With near instant settlement, subject to regulatory controls, the NBFC disperses loan in CBDC directly to the merchant. No manual paperwork, no multi-day settlement cycle. The NBFC act, acts as a translator, speaking crypto on one side and sovereign money on the other side. The tokenization shift. At this point, skepticism appears. Regulators will never allow this. In reality, many regulators have publicly stated objectives around transparency, traceability, control the programmability of money, This is where tokenized deposits and programmable disbursements emerge. Imagine a loan issued not as an unrestricted cash but as a programmable digital unit usable only for specific approved purposes. Factory inputs, education fees, healthcare expenses, the money itself enforces intent. This is not a this is not this does not eliminate a risk, but it can significantly reduce certain classes of misuse and fraud. For sectors like microfinance and MSME lending, this represents a structural upgrade, not disruption. The risk and the vision. The bridge is not without cracks. Smart contract security is critical. Operational governance matters. Privacy must be preserved. Any real-world implementation would require explicit regulatory approval, robust consumer safeguards, and continuous oversight. The future is not purely centralized and it is not fully decentralized, it is hybrid finance. In this world, banks remain the walls, digital assets remain the asset class, and when the NBFC become the operating layer. The is not a question of convergence is not a question of if, only how responsibly it is built. The real question is, are you prepared for the system that emerges in between? If this made you think, hit like and comment below. I have one question for you. Do you trust automated systems more than traditional intermediaries? Thanks for watching. Stay strong, guys. See you in the next video.